What if I told you that the money you casually spend every week on food deliveries, subscriptions, or random expenses could one day pay you back every single month? I'm talking about just $120 a week. Not trading, not side hustles, not chasing hot stocks. Just consistently putting that $120 into the right investments. In this video, I'm going to show you how investing $120 per week into 2 Fidelity index funds can realistically grow into around $3,000 per month in passive income over the long term. This isn't about overnight results or getting rich fast. It's about building something slowly, consistently, and intelligently, using simple index funds that thousands of long-term investors already trust. I'll walk you through the exact funds, how they work, and what this strategy can realistically turn into after years, using clear numbers and one straightforward scenario so everything stays easy to follow. If you've ever wondered whether small, boring investments can actually lead to real financial freedom, stick with me, because the way these 2 funds work together is what makes this whole thing powerful. Before we get into the numbers, let's talk about why Fidelity and why index funds, because this foundation is what makes the entire strategy work. Fidelity is one of the largest and most established investment firms in the world. They manage trillions of dollars for everyday investors, retirement accounts, and institutions. When you're building something meant to last 20 or 30 years, you don't want experimental products or flashy strategies. You want stability, scale, and low costs. And that's where index funds come in. Index funds don't try to beat the market. They don't rely on predictions or perfect timing. Instead, they simply track a basket of companies or assets and let long-term growth and income do the heavy lifting. Over decades, that simplicity is incredibly powerful, especially when fees are kept low. The key to building passive income is not relying on a single source. That's why this strategy uses 2 different Fidelity index funds that generate income in very different ways. The first fund is the Fidelity High Dividend ETF, ticker FDVV. This fund holds around 120 dividend-paying companies and tracks the Fidelity High Dividend Index. It's designed to capture established businesses that consistently generate profits and return part of those profits to investors as dividends. We're talking about recognizable names like Nvidia, Apple, Microsoft, JP Morgan Chase, Broadcom, ExxonMobil, and Coca-Cola. These aren't speculative startups. These are companies with strong cash flow and a history of paying and growing income over time. What makes FDVVV especially interesting is that it isn't just chasing high yields. The fund currently yields around 2.7%, which might not sound exciting at first, but here's the key. The dividend growth rate over the past 5 years has averaged nearly 10% annually. That means the income you collect doesn't just sit there, it grows. Even if the yield looks modest today, growing dividends can significantly boost passive income as your portfolio gets larger and these companies continue raising their payouts. The fund charges an expense ratio of just 0.15%, and with over $8 billion in assets, it's established, liquid, and built for the long term. Over the past 5 years, FDVV has delivered annualized total returns around 16%, combining both dividend income and price appreciation. The second fund adds a completely different income engine, real estate. This is the Fidelity MSCI Real Estate ETF, ticker FREL. Instead of relying on corporate profits, FREL owns around 132 real estate investment trusts, or REITs. These are companies that own and operate income-producing properties like warehouses, apartment complexes, data centers, cell towers, and shopping centers. Real estate works so well for income because rent gets paid regardless of what the stock market does in the short term. That rental income is then passed along to investors as regular distributions. FREL currently yields around 3.3%, higher than FDVV, and it does this with an expense ratio of just 0.08%, one of the lowest cost real estate funds available. Since its inception in 2015, the fund has delivered steady performance with 10-year annualized returns around 6%. This fund gives you exposure to real estate without the headaches of being a landlord. No tenants calling you, no maintenance, no large upfront capital, just steady participation in real estate income through an index structure. When you combine an FDVV and FREL together, splitting your $120 per week evenly between them, something important happens. You're no longer depending on just one type of income. One side of the portfolio is driven by dividend-paying companies across technology, financials, consumer staples, and energy. The other side is driven by real estate cash flow from warehouses, apartments, and infrastructure. They respond differently to economic conditions, interest rates, and inflation, which adds resilience to the overall strategy. Together, these two funds create a blended income yield around 3%, and that's before accounting for dividend growth over time. This combination builds a portfolio not just to grow, but to pay you. Now let's talk about how the weekly investment actually works. $120 per week might not feel like much, but over a year, that's $6,240 invested consistently. You're putting $60 into FDVV and $60 into FREL every single week. More importantly, every dollar of income these funds generate gets reinvested back into the portfolio. Those dividends and distributions buy more shares, which then produce even more income in the future. This is where compounding really starts to show its power. Now let's get into the numbers and see what this actually looks like. Remember, this is all based on investing $120 per week, every week, split evenly between FDVV and FREL, with all income reinvested along the way. We're using a realistic long-term scenario based on historical performance to keep things simple and grounded. Let's start with the early years. After 5 years, you would have invested about $31,200 in total. At this stage, the portfolio grows to roughly $38,000. The passive income generated here is still small, around $95 per month, and that's completely normal. This phase isn't about income yet, it's about building the base. Most people quit here because the results don't feel exciting, but this is exactly where patience matters. Fast forward to 10 years. By now, you've invested about $62,400, and the portfolio grows to nearly $100,000. At this point, you're looking at around $250 per month in passive income, generated without selling anything. The strategy starts to feel real here. The money you invested years ago is now working alongside your new contributions, and the compounding effect becomes easier to see. Now let's jump to 20 years, where things really start to change. After 2 decades, the total amount invested is around $124,800, but the portfolio value grows to roughly $357,000. At this stage, the passive income crosses into 4 figures, nearly $900 per month. This is no longer just extra cash. This level of income can cover major monthly expenses, rent, utilities, groceries, or even a car payment, depending on where you live. And the most important part, the portfolio is still growing while paying income. Now let's look at the long-term result. After 30 years of consistent investing, the total amount invested comes to about $187,200. Thanks to compounding and reinvestment, the portfolio grows to approximately $1,025,000. At this point, the passive income generated by the portfolio reaches around $2,500 per month based on the current blended yield. And as dividend income grows over time, which FDVV has done at nearly 10% annually, that monthly figure realistically approaches $3,000 per month without selling a single share. This is where passive income can realistically replace a significant portion of a full-time paycheck. What's important to understand here is that nothing dramatic changed in year 30. There was no lucky trade, no sudden windfall. The difference came from time, consistency, and allowing income to compound instead of spending it early. This is why the strategy works. The first 10 years feel slow, the next 10 years feel rewarding, and the final 10 years are where the system does most of the work for you. If you try to rush this process, it falls apart. But if you let it run, the math starts to work in your favor. The real takeaway here is this: you don't need perfect timing, advanced knowledge, or a huge starting balance. You need consistency, discipline, and time. That's the power of building passive income the slow, intentional way.